This video is for educational purposes only, not financial advice. Always consult a certified financial advisor before investing. We are not affiliated with State Street or any ETF provider. What if you could own gold without storing a single bar? What if one simple investment gave you direct exposure to the price of real physical gold, the asset that has protected wealth for thousands of years? And what if that investment is now trading near all-time highs in 2026 with gold prices reaching record levels? Today we are breaking down GLD, the SPDR Gold Shares ETF, the world's largest gold ETF and one of the most powerful wealth protection tools available to investors in 2026. Welcome to ETF Holdings USA, the only channel that breaks down every major ETF in America so you can invest smarter. In this video, we will cover what GLD is, who manages it, what is actually inside it, how it tracks gold prices, its 5-year performance, expense ratio, GLD versus IAU comparison, who should invest, future outlook for gold in 2026, and whether beginners should invest. Let us get started. GLD stands for SPDR Gold Shares. It is an exchange-traded fund that tracks the price of physical gold bullion. That means when you buy one share of GLD, you are essentially buying ownership of a fraction of real physical gold stored in secure vaults. GLD does not invest in gold mining companies. It does not invest in gold futures contracts. It holds actual physical gold bars stored in HSBC bank vaults in London. As of May 14, 2026, GLD is trading at $429.01 per share. The 52-week price range has been from $291.78 to $509.70, which shows how dramatically gold has moved in the last year. GLD was launched on November 18, 2004. That makes it the first and oldest gold ETF ever created in the United States. It currently has a market capitalization of approximately $163 billion, making it one of the largest ETFs of any kind in the entire world. Gold is managed by State Street Investment Management, which is one of the largest asset management firms on the planet. State Street is the same company that manages SPY, the world's first stock ETF, so GLD has the backing of one of the most trusted names in the global investment industry. The custodian of GLD's physical gold is HSBC Bank based in London. That means the actual gold bars are sitting in secure professional vaults and are audited regularly. This institutional-level security is one major reason why investors trust GLD with hundreds of billions of dollars. Now let us talk about what is actually inside GLD. Unlike stock ETFs, which hold dozens or hundreds of companies, GLD holds only one thing: physical gold. 100% of GLD's assets are in physical gold bullion. Each share of GLD represents approximately 1/10 of an ounce of gold. So if gold is priced at $4,300 per ounce, one share of GLD would be worth approximately $430. The fund's performance tracks gold prices very closely minus the 0.40% annual expense ratio. GLD does not pay any dividends because gold itself does not generate income. The return on GLD comes entirely from the price appreciation of gold. Now let us talk about why gold and GLD are so important in 2026. Gold reached an all-time high of $509.70 per share on GLD in the last 52 weeks. That is an extraordinary move. Gold has been surging in 2026 because of several powerful factors. First, global inflation concerns continue pushing investors toward hard assets like gold. Second, central banks around the world, including China, India, Russia, and many others, have been buying gold at record levels. Third, geopolitical uncertainty is making investors move money into safe haven assets. Fourth, the US dollar has been under pressure, which typically pushes gold prices higher because gold is priced in dollars. These factors combined have created one of the strongest gold bull markets in decades, and GLD is the easiest way for everyday investors to participate. Now let us look at the 5-year performance of GLD. Over the last 5 years, GLD has gone from approximately $160 per share to its current level near $429 per share in May 2026. That represents a gain of approximately 168% over 5 years. This strong performance has made GLD one of the best performing major ETFs of the last 5 years, significantly outperforming many traditional stock ETFs during the same period. Gold tends to perform especially well during periods of economic uncertainty, high inflation, and weak stock markets. It acts as a natural hedge against financial system risk. Now let us talk about the expense ratio of GLD. GLD charges an expense ratio of 0.40%. That means for every $10,000 invested in GLD you pay approximately $40 per year in management fees. This is higher than stock ETFs like VU, which charges only 0.03%. However, for a commodity ETF storing physical gold in professional vaults, 0.40% is considered reasonable by most investors. If you want a lower-cost alternative, iShares Gold Trust ticker IAU charges only 0.25% and SPDR Gold Shares ticker GLDM charges only 0.10%. These are cheaper options, but GLD offers much higher daily trading volume and better liquidity, especially for larger investors. Now let us compare GLD versus IAU, which is the most common comparison investors make. GLD charges 0.40% expense ratio while IAU charges only 0.25%. GLD represents 1/10 of an ounce of gold per share, while IAU represents 1/100th of an ounce per share. GLD has approximately $163 billion in assets, while IAU has approximately $50 billion. GLD trades approximately 9.48 million shares per day, making it significantly more liquid than IAU. So the choice between GLD and IAU comes down to cost versus liquidity. Long-term investors who want to minimize fees may prefer IAU. Institutional investors and traders who need maximum liquidity prefer GLD. Both give you exposure to the same asset, physical gold. Now let us talk about who should invest in GLD. GLD may be an excellent choice for investors who want to protect their wealth against inflation, investors who want a safe haven during economic uncertainty, investors who want to diversify their portfolio away from stocks and bonds, retirees and conservative investors who want a stable store of value, and investors who believe gold prices will continue rising in 2026 and beyond. GLD may not be the best choice for investors focused entirely on income because gold pays no dividends. Young investors focused purely on maximum long-term growth who may prefer stock ETFs, and investors who want to invest in gold mining companies rather than physical gold itself. Looking ahead to the future of GLD and gold in 2026 and beyond, most analysts remain bullish on gold for several key reasons. Central bank gold buying continues at record levels globally. U.S. national debt and deficit spending continue growing, which weakens confidence in paper currencies. Inflation remains a concern for many investors and institutions worldwide. Geopolitical tensions, including trade wars and global conflicts, continue driving safe haven demand. If any major financial crisis or recession occurs, gold and GLD could see dramatic price increases similar to 2008 when gold surged. The main risk for GLD is if inflation comes down sharply, the US dollar strengthens significantly, or global stability improves dramatically, which could reduce safe haven demand. But many analysts believe the long-term structural case for gold remains very strong in 2026. So should beginners invest in GLD? For many investors, the answer is yes, as part of a diversified portfolio. Most financial advisors suggest keeping between 5 and 10% of a portfolio in gold as a hedge and diversifier. GLD makes it extremely easy to add gold exposure to any investment account without needing to store physical gold yourself. The simplicity, liquidity, and institutional trust behind GLD make it one of the best ways to own gold in 2026. To sum it all up, GLD is the world's largest gold ETF. It holds 100% physical gold bullion in secure vaults. It is trading at $429 per share in May 2026 after reaching an all-time high near $509. It has gained approximately 168% over the last 5 years. It charges a 0.40% expense ratio. It pays no dividends. And it is managed by State Street, one of the most trusted names in finance. Now we want to hear from you. In 2026, would you rather invest in gold with GLD or stick with stock ETFs like VU or QQQ? Comment below and tell us why. If you found this breakdown helpful, hit like and subscribe to ETF Holdings USA for more ETF breakdowns every single day. New video uploaded daily. Thanks for watching. This video is for educational purposes only, not financial advice.